The stock market is a complex machine. It moves based on a constant flow of new information. Some of this information comes from economic data, some comes from company announcements, and some from events happening halfway around the world. For any investor, making sense of these signals can feel overwhelming. The main problem right now is the constant barrage of news and data. It creates noise and uncertainty, making decisions difficult. It is easy to get lost in daily headlines and forget your long-term plan. This uncertainty leads to tough questions. Should I be buying more stocks today? Should I be selling to protect my capital? Is now a good time to enter, or should I wait? These questions are normal, but reacting to every headline is costly. The real challenge is to filter signal from noise and stay disciplined. Organize the market drivers into 5 categories: economic data, central bank policy, corporate earnings, geopolitical events, and overall market sentiment. Each area is a different piece of the puzzle. Together, they build a complete picture of the environment. This framework lets you process information calmly and systematically. Thinking in categories helps you move from reacting to responding. A reaction is emotional and fast. A response is thoughtful and deliberate. Put single data points into a larger context. Ask how one signal affects the others. Does changing data make a policy shift more or less likely? This structure helps you navigate choppiness and make informed decisions. Economic reports are the most frequent market movers. They act like regular health checkups for the economy. Key reports include jobs, inflation like CPI, and growth GDP. Good data can spark optimism and lift stocks. Bad data can slow down fears and weigh on markets. Sometimes good news is bad news if it risks overheating. That could push central banks to raise rates. Higher rates raise borrowing costs and make bonds more attractive. Focus on trends, not one report. Today, inflation and employment remain the most influential. If inflation sustains lower, policy can ease, a positive signal. If inflation is sticky, rates likely stay higher for longer, a headwind. Ask, does this data show a stronger or weaker economy, and how might the central bank react? Central banks, like the U.S. Federal Reserve, wield immense power over markets. They set short-term interest rates and manage money supply. When they speak, the investment world listens. A single phrase can send markets soaring or tumbling. Policy sets, borrowing costs for companies and households. Language is parsed for hawkish or dovish clues. Hawkish, keep rates high to fight inflation, tough on growth and stocks. Dovish, lower rates to support the economy, typically positive for equities. The market handicaps the timing of the next move, cut or hold. Uncertainty fuels volatility, clarity reduces it. Until clarity, every data point is viewed through the policy lens. Have a plan for multiple interest rate scenarios. Ask, are my holdings resilient if rates stay high? And how would they perform if rates are cut unexpectedly? Diversification prepares you for varied outcomes. No need to predict every move. Earnings reports bring the market down to the company level. They are a business report card. Revenue and profits. Over time, earnings growth drives stock prices. Beats can spark price jumps. Misses can hit hard. A weak report can drop a stock even in a rising market. 4 times a year, focus intensifies. Forward guidance can matter more than last quarter. Great results with cautious outlook can still sink shares. Watch market leaders, tech, banks, and large consumer brands. Their results are bellwethers for the broader economy. Upward revisions across sectors signal health. Broad cuts urge caution. Use the season to take the pulse of what you own. Look for, did sales grow? Did profits grow? What did the CEO say? Confirm long-term holdings remain on solid footing and executing plans. Earnings are your on-the-ground reality check. Markets do not operate in a vacuum. They are linked to global events. Geopolitics is the wild card. Conflicts, trade disputes, elections, agreements, often unpredictable. Surprises create sharp market moves via uncertainty. Trade wars can disrupt supply chains and squeeze profits. Conflicts can spike oil, raising transport costs and pressuring consumers. Impacts show up in sectors. Defense up, travel down. Energy swings. Risks are reassessed globally in real time. Diversify across regions to reduce single-event risk. Stay aware of flashpoints and trade routes. Small events can cascade through the system. Volatility brings short-term opportunity, but long-term investors should stay calm. History shows markets recover from geopolitical shocks. Do not let headlines dictate your long-term strategy. A robust, diversified plan is your best defense. Market sentiment is the collective mood. Greed versus fear. Greed bids prices above fundamentals and can create bubbles. Fear drives selling and flight to safety, sometimes below intrinsic value. High VIX equals high fear, low VIX signals complacency. Outflows show pessimism. Inflows show growing confidence. Extreme bearishness can be a contrarian buy signal. Extreme bullishness can be a cue for caution. Use sentiment as one input. Avoid herd mentality. Given crosscurrents, the path forward requires a plan. Problem: uncertainty. Insight: 5 drivers. Plan: simple, deliberate steps. Tailor your strategy to risk tolerance and time horizon. Build a safety buffer to avoid forced selling. Rebalance regularly. Favor quality cash flow businesses. Diversify broadly and automate with dollar-cost averaging. Stay calm. Use facts. Review the 5 catalysts. Avoid big mistakes and let time work in your favor.